Hello everyone, here is the answer to exercise 1 in unit 4 of AC201. In this problem we need to determine which section, and by that I mean operating, investing, financing, or non-cash, each of these items will appear under on the statement of cash flows if we are using the indirect method. We also need to determine if this change or this line item is going to increase or decrease the company's cash flow. So the first thing we have is an increase in accounts receivable. Accounts receivable is a current asset, and all current assets always appear in the operating section. If our accounts receivable is going up, that means we did more work that people are paying for on account. They're not paying us in cash at the time. So an increase to accounts receivable is going to be a decrease to cash, and this is true for all current assets. They work the opposite of cash. So if there's an increase in your current asset, it has to be a decrease to your cash flow. The cash payment of dividends is related, it's a withdrawal account, and it's related to equity. It's related to our common stock, and anything related to equity, including the withdrawal, is going to appear in the financing section. What we're doing is taking money out of the company and giving it to our owners, our shareholders, so our company's cash flow has to be decreasing. The purchase of equipment is next. Equipment is a non-current asset, a long-term asset. Well, all long-term assets always appear in the investing section. And if we're paying for this equipment in cash, what has to be happening to our cash flow? It has to be decreasing. Underneath this, we have a decrease in insurance payable. That is a current liability, and just like all current assets go in the operating section, all current liabilities go in the operating section. They, however, work the same way as cash. If we have a decrease in insurance payable, that means we paid off more of our insurance debt during the period. And if we're paying off more of our debt related to insurance, well, then our cash flow has to be going down. Gain on sale of long-term investments. All gains always appear in the operating section in the portion which adjusts our net income to our net change in cash from operating, basically adjusts our net income. This gain that we have here is going to increase our net income. However, it didn't increase the amount of cash we received. So to adjust our net income from our overall net income to just the portion of our net income which was related to cash transactions, we have to remove it from our book. So all gains are always subtracted on the statement of cash flows. Next up, we have the issuance of common stock. Again, an equity account, and all equity accounts appear in financing. We are selling shares of stock to owners who are paying us for them in cash, which means our cash flow has to be going up when we issue common stock. Same concept applies to the cash receipt from the signing of notes payable. It is a long-term piece of debt, and all long-term debt that you have, all long-term liabilities, appears in the financing section. We're taking out a loan, which means our cash flow has to be going up. Next up, we have the acquisition of a building by signing a mortgage payable. So we're getting a building, and we're getting a loan from the bank, a mortgage, for this particular building that we're getting. Well, guess what? No cash is changing hands there, right? We're acquiring the asset, but we're not acquiring it by transferring cash. We're acquiring it by signing debt. So that becomes a non-cash transaction, which means there's no increase or decrease to cash. It stays exactly the same because there's no cash involved in the transaction. Next, we have the sale of long-term investments. And the sale of long-term investments is related to a long-term asset. In this case, our long-term investments. All non-current assets, if you will, always appear in the investing section. And if we're selling these investments, say we own stock in another company, well, we're selling them, and what are we getting in return? We're getting cash. So our cash flow has to be increasing. We have an increase in interest payable from bonds issued. So interest payable is a current liability, and like all current liabilities, it's going to go in the operating section. And this increase that we have in interest payable means we spent less cash during this period than we did the last, paying out interest to our bondholders. And since we spent less cash, that has to be increasing our cash flow. We have the issuance of bonds payable. We sold bonds to the public to raise cash for our company. Well, that's these bonds, I'm assuming in this case, are long-term debt, because most bonds are more than a year in length, and all long-term debt appears in the financing section. So we're going to issue these bonds payable, receive cash in exchange. Our cash flow is going to be going up. Next up, we have a decrease in inventory. Inventory is a current asset. All current assets appear in the operating section. If our inventory decreased, one of two things had to happen. Either we made or purchased less inventory, therefore spending less money to acquire that inventory, or we made the same amount of inventory and we sold more of that inventory. In either of those circumstances, what's going to happen to our cash flow is it's going to be going up. We either spent less money to make inventory or we sold more and got more cash in exchange. Again, a decrease in a current asset is always an increase to cash flow. Next up, we have an increase in supplies. And supplies, our current asset, will also appear in operating. If our supplies are increasing, that means we bought more of them. If we bought more of them, that means we spent more money. So that increase in our current asset is going to result in a decrease to our cash flow. Depreciation expense, just like the gain way above, always appears in the adjustment section of your operating section on your statement of cash flows. That depreciation decreased our net income, but since we're adjusting net income to the portion that only deals with cash, it didn't affect our cash, which means to adjust, what we got to do is do the opposite, and we're going to add that back in. Depreciation always gets added under the adjustments in the operating section of a statement of cash flows. We have the purchase of vehicles. We're going to be using these vehicles for more than a period of a year, therefore long-term assets, and they're going to go in the investing section. And since we're paying for them, what's going to happen to our cash? It's going to go down. We have a decrease in accounts payable. An accounts payable is a current liability. Anything that is current, either an asset or a liability, always goes in the operating section. If our accounts payable went down, we owe less money. Well, how do you get to owing less money? You pay off more of your debt, which means a decrease in accounts payable is going to be a decrease to cash. And again, the same concept always holds true. If there's a decrease in a current liability, it decreases cash. If there's an increase in a current liability, it increases cash. And for our last item, we have the retirement of bonds payable by issuing preferred stock. So we have these bonds payable that have been out in the hands of our bondholders, and we have to pay them off. And we don't want to transfer the cash at the time that we have to pay off these bonds when they've matured, so we give them preferred stock instead. Well, we got out of our debt without issuing cash. And we didn't take in any cash when we sold that preferred stock. We issued it out because we wanted to get out of that debt. We traded debt for stock, and in no part of that was any cash involved. So that is a non-cash transaction and will not have any effect on your cash balance.